What is up, guys? D Chantilly here, and today we have a new series called the Versus Series where we'll take a look at two, sometimes maybe three industry leaders, compare them and see which one is the better investment. I wanted to do a face cam for this video, but the quietest place in the house, which is the garage, happens to have a light out, and it's not one of those lights that you can like replace, like I don't know what it's called, and I don't know what the other kind of light is called, but you all know what I mean. And so in the future, I hope to do a face cam for this series to see which one you all like better, maybe the gameplay or the face cam. But for right now, please enjoy the Nuketown gameplay. I'm not quite sure. I think it was a 60-something kill game. It was a pretty good game, but that's not the point of this video. We're going to talk about FedEx and UPS and how these very similar companies could be going in a very different direction. And so without further ado, let's jump right into it. And I know you guys are probably tired of hearing this, but 2020 was a crazy year. The pandemic caused people to get sick, obviously. It caused people to stay indoors with the government mandated lockdowns, and the precautions really benefited the e-commerce companies who saw their sales jump tremendously, which means they had more products to ship. This is where UPS, FedEx, United States Postal Service, which is having major delays, and Amazon come into play. But for the sake of this video, we're going to be comparing the top two dogs in the United Parcel Service in Federal Express. According to eMarketer, U.S. online shopping sales are projected to reach $795 billion in 2020. That is a 32% year-over-year increase. And this has really put strain on companies like UPS, FedEx, the United States Postal Service, and Amazon. For example, UPS in March, when the pandemic broke out, they suspended their UPS service guarantee, which is also referred to as the UPS money back guarantee. FedEx also suspended their money back guarantee. These parcel services have been really overwhelmed with orders, which increased operating costs and really put their distribution centers to the test. But which company will be a better investment down the line? And so we're going to take a look at their most recent quarter and the investments they've been making into the future. And first, let's start with FedEx. And keep in mind that FedEx and UPS have different fiscal years. UPS is on your standard calendar beginning in January, with quarter one being January through March, second quarter April through June, etc. FedEx recently reported their 2021 second quarter earnings, and their fiscal year starts in June. And so just keep that in mind. Let's take a look at FedEx's most recent quarter, which saw them increase revenue substantially. They did $20.6 billion in revenue, a 19% year-over-year increase, operating income of $1.47 billion, a 165% increase, net income of $1.23 billion, a 119% increase, and earnings per share of $4.83, a 113% increase. A very good quarter by any metric. Now let's take a look at how that revenue broke down by segment, which they have 4 segments and a 5th one entitled Other and Eliminations. FedEx Express did $10.318 billion, a 14% increase, with an operating income of $900 million, a 281% increase. FedEx Ground did $7.344 billion, a 38% increase year over year, with an operating income of $552 million, a 61% increase year over year. FedEx Freight did $1.936 billion, a 5% increase, with an operating income of $252 million, a 79% increase. FedEx Services segment did $8 million, a 60% increase, and they didn't disclose the operating income or loss from this segment. In the Other and Eliminations did $907 million, a 16% decrease, with an operating loss of $239 million. A big thing that helped all transportation companies this year was the fact that crude was beaten down, actually going negative in the futures market back in 2020. I actually remember that. Crazy times. FedEx saw a 30% decline in fuel costs this year, and I said this earlier in the video, and it's worthy of saying it again. It was a very good quarter from FedEx. FedEx also has a solid balance sheet with about $8.3 billion in cash and cash equivalents, and the current ratio, which is current assets divided by current liabilities, of 1.75 times. And that's comforting because it allows FedEx to take advantage of some opportunities that may present themselves, which they did very recently, and we're going to talk about that in just a second. But first, let's talk about the acquisition of TNT Express, which is a freight and transportation company headquartered in the Netherlands. And fun fact, rival UPS had originally agreed to buy TNT Express for about $7 billion in 2012, but had to abandon it in 2013 after the European Commission sent a notice informing them they would be working to prohibit the acquisition. 3 years later, FedEx would acquire TNT Express for 4.4 billion euros, By combining TNT Express with FedEx, it accounted for the second largest operator in the European Union with 17% in 2016. TNT Express also has a nice footprint in Latin America, fueled by their 2007 purchase of Mercuro, Brazil's express market leader at the time. And there's not much information about TNT, but from what I can find, it should be good in the long run. It hasn't been the home run FedEx may have been hoping for, but 10 to 15 years from now, it should be a decent acquisition. Another acquisition that can help FedEx in the long run, especially against rivals like Amazon, a rival they've had a messy breakup with. Even though Amazon was never considered a major customer of FedEx, they had their back and forth. This is an excerpt from an article published by CNN Business that provided a small timeline of what happened. And I quote, FedEx stopped carrying Amazon shipments as a part of its express business in June, and Amazon ended its contract with FedEx Ground in August. FedEx Ground is the company's lower-priced service which delivers to homes and businesses. Earlier this month, Amazon told its third-party sellers to stop using FedEx Ground for their Amazon Prime shipments, saying it was concerned about reliability. FedEx also stopped letting Amazon use its air services in June. And that was the build-up to FedEx acquiring ShopRunner to compete with Amazon and Walmart, who recently started Walmart Plus. ShopRunner is very similar to Amazon Prime with the free 2-day shipping and free returns, but it's for a modest price of $79 a year. With the membership, you'll have access to many different brands. Some include Calvin Klein, Fanatics, Reebok, Timberland, a lot of apparel companies from what I've seen. But, over time, they'll expand that. But FedEx's infrastructure with the business model like ShopRunner, we've seen with Amazon and more recently Walmart, it can work. FedEx feels that this acquisition will increase value for the brands, merchants, and consumers, and they'll complement their e-commerce portfolio. This will be a very interesting acquisition to watch unfold over the next, let's say, 3 to 5 years to see, number one, how they integrate it, and if it really becomes the needle mover they think it could be. Now let's talk about the rival, United Parcel Service, also known as UPS. In their most recent quarter, they saw revenue of $21.238 billion, a 15% increase year over year. Operating profit of $2.363 billion, 11% increase year over year. Net income of $1.957 billion, an 11.8% increase year over year. And earnings per share of $2.24 a share, and about 11% increase. When you look at it by segment, which they have 3 main segments, the U.S. domestic segment did $13.225 billion, a 15% increase with an operating profit of $1.098 billion, about a 9.7% decrease. The international segment did about $4.087 billion, a 19.97% increase. UPS cited average daily volume grew by 12.1% with double-digit export growth volume globally and continued strong outbound demand from Asia. They saw an operating profit of $966 million, a 44% increase. Supply chain and freight saw a revenue of $3.926 billion, a 16% year-over-year increase. UPS once again cited Asia as a big fueler of growth. Revenue increased 16.5%, driven by strong freight forward demand out of Asia, and that saw an operating profit of $229 million, a 22% increase. Asia was a major boost for UPS in the most recent quarter. It really helped the international segment outperform. Like we said earlier, they had $966 million in operating profit, which was a 44% year-over-year increase. Like FedEx, UPS has a solid balance sheet that no one should be worried about, and it's in a good position to invest in its future. UPS has about $8.8 billion in cash and cash equivalents, with a current ratio of about 1.28 times. And so UPS has gone pretty hard into brokerages. In 2015, it acquired Coyote Logistics for $1.8 billion. And if you're a truck driver that uses load boards, odds are you're pretty familiar with this company. It's a third-party logistics provider that connects shippers and carriers. You can find truck drivers, rail services, ocean services, air services. Anything freight related, Coyote can help you with that. In 2017, they acquired Freightex Limited to increase their truckload brokerage footprint in Europe, but it's also been rebranded into Coyote. These are great acquisitions that fit seamlessly into what UPS already offers. And so when you look at each company, I believe they're trending in different directions, and that's not a bad thing. FedEx, with the acquisition of ShopRunner, is making a move into e-commerce. I believe they want to leverage their infrastructure to, in a sense, not literally be more like Amazon and Walmart, because they can use their infrastructure and resources to streamline the delivery process as they grow and have more control over the entire process from when the customer buys something to when they receive it. Because the hundreds of brands that are already on ShopRunner, when the customer buys something on the platform, odds are it's being shipped through FedEx. And as more people come to that platform, there'll be more parcels for FedEx to ship. And so FedEx already has an e-commerce side of their business, and they can push people onto the ShopRunner platform, saying, hey, if you get on the ShopRunner platform, we'll be able to get your customers 2-day shipping and all these other benefits that make people want to join that platform, which means more business for FedEx. And so in a sense, this is a very good acquisition if it goes right, which you could say for most acquisitions. But in all seriousness, I do think ShopRunner could be a boost for FedEx. As far as UPS, they've committed to being a logistics provider, gobbling up the brokerage apps in the US and Europe. And I like that strategy, probably more than FedEx's strategy, because when you look at FedEx, they're going to have to put money in the ShopRunner, get it to scale, try to get more people onto the platform. And then you have the payoff. While UPS buys these brokerage apps, they connect the two sides, they take their fee and go on with their day. And so I really like both company strategies, but I tend to prefer UPS's a little bit more. And let's put each company side by side by their most recent quarter, and here's how it looks. Revenue was comparable. UPS did about $1 billion more. UPS is also significantly more profitable, with margins almost twice as high as FedEx, which could be the reason UPS trades at a higher multiple to FedEx. As of December 29th, 2020, UPS has a price to earnings of about 32 times, while FedEx sits at about 28 times. Pretty comparable, not too much of a difference, but nonetheless a difference. UPS trades about 1.83 times sales, while FedEx is just a 0.92. I believe UPS does deserve the higher price to earnings and the higher price to sales over FedEx, because FedEx is going to have to invest heavily into ShopRunner to get the acquisition to the point where it'll be worth it. While UPS, with the brokerage apps that are always needed, people use that for their livelihoods, they will continue to connect both sides and collect their fees. And so now it's time for me to say which opportunity I see as the best. And before we do that, we have to talk about the dividend. Both companies offer a dividend. FedEx has a dividend of $2.60 a share. I prefer to tell you guys the actual dollar amount because the yield changes when the stock price changes. And I know you really want to know the dollar amount, but the yield is 0.99%. UPS has a dividend of $4.04 a share, giving it a yield of 2.37%. And so we all know we have to factor that into our potential return. So now it's time for me to choose which company is the better investment. And it's a tough one. I'm going to be honest. It's very tough. FedEx is only a $69.33 billion company. And I say only because UPS is more than double the size of FedEx in terms of market cap, sitting at $146.11 billion. I'm a big fan of the ShopRunner acquisition because I think it could be a strong grower for FedEx if done right. But I'm going to have to go with UPS. I feel like the higher margins are there. I feel like the overall business is stronger. They have that relationship with Amazon, which continues to be a decent chunk of their revenue. And as long as they have that Amazon partnership in place, because Amazon is in no position to cut off UPS, and I don't think they're particularly close to getting to that point. And so there you guys have it. Hope you guys enjoyed the video. If there's any recommendations you want me to do to improve the series, I am all ears. I hope you guys enjoyed. Please like, comment, and subscribe if you did. And let me know which verses you want to see next.